So as per Federal Reserve data, Canadian housing market has been in the exuberant stage for the last 26 quarters, and for the first time it is about to resent back to its normal value. What does it mean with regards to the possible rate hikes coming from Bank of Canada next week, plus the geopolitical crisis that has broken out in Europe, how this is going to impact the global supply chain, further disruptions, as well as the rising inflation. So a lot to talk about in this video, so without further ado, let's dive in. If you are new to my channel, my name is Yasin and I make these videos to educate my audience about real estate market in Canada, general investing strategies, macroeconomics, finance, and technical sales. So if you're interested in any of these topics, feel free to subscribe so that you don't miss any topic in the future. Now back to the topic. Now, Federal Reserve has published this exuberance index chart, and what it tells you is the gap between the price growth and the market fundamentals. What is market fundamentals? Basically, the market moves based upon the fundamentals like, population growth, unemployment rate, economic opportunities, and if these market indicators are pointing towards a consistent growth, then the housing market moves along with it, right? So, but if the price growth is far ahead of the market fundamentals, that means it is going into a possible bubble, and when the bubble persists, then it is likely to lead for a price correction at some point. Typically what we have seen, these kind of exuberance exists for 1 quarter or 2 quarters, but if the exuberance period exists for, let's say, quarters over quarters, that leads to a high degree of correction further down the road. This exuberance index is tracking the gap between the price growth and the market fundamentals. So what you can see here, last time we saw a huge spike in terms of the market sentiment was back in 2002, right? And since then it kind of fluctuated a little bit, but it was still way above the critical line, which shows the fundamental benchmark. And when we were hit by the global financial crisis back in 2008, 2007, the exuberance index came right back down, crosses the critical line, and stayed there for a little while until 2015, when it crosses that critical line again, went straight up in 2017, and then receding back. And that particularly aligns with what we have seen in the past. When the market was corrected back in 2017, we saw the sentiment straight went down all the way to the critical line, and it was about to cross it, but then what we saw happen in 2020, a huge inflow of capital into the market, which pops up the real estate bubble even further higher. And now for the first time we are seeing this index is sharply declining southwards. So that shows the market sentiment with regards to buyer excitement about buying these properties is trying to go down, or at least slowing down the momentum in the market. And this is basically very much in line with what we are seeing in the field, because I'm connected with a lot of different realtors in the market, and all of them are now saying there is a spike of inventory coming into the market, which is going to give a lot more options to the buyer. And now the buyers are taking time, as well as the buyer fatigue is there because the house prices have broken all the previous records. People are bidding $200,000-$300,000 more over asking. It has been so difficult to buy a property these days because of this buyer fatigue and the less amount of options available in the market. The buyer sentiment is kind of losing in the market, and this is what we're seeing with regards to this data as well. The new mortgage lending is also shrinking as per the December data. Even though it's a lagging indicator, I wouldn't be too much surprised because of that, because this chart shows you a typical cycle year over year over year. You can see, from January it starts to climbing up, because the January is that market, very slow market. But as we move into the spring market, the market starts getting heated. By the time we reach the summer, this is the peak of the market, and the market starts going down. So you can see a consistent cycle year over year, but it is showing you an upward trend. So the new mortgage lending is kind of decreasing almost like 19% year over year. Key point here is this is comparing the insured and uninsured mortgages. And if you don't know what is insured mortgage, basically if you have less than 20% down towards the purchase of the property, you must have to purchase an insurance from CMHC or other organizations to insure that mortgage, because your chance of getting default on that financial commitment is much higher. So what we are seeing in this chart is the trend shows the insured mortgages are kind of flat and maybe declining going forward, versus the uninsured mortgages are climbing much higher, which shows that typically the type of buyers are in the market are not first-time home buyers, and they are not putting less than 20% down towards the purchase. Most of these buyers have access to a lot of capital, primarily coming from a different source of income outside of the country, or maybe they are using HELOC or home equity line of credit, or refinancing in other words. And going back to my previous point, because the inventory is so low in the last month or so, this is putting a lot of upward price pressure on the available inventory. Like if you have less than 2 months of inventory, this is super tight seller market, and buyers have very less chance to acquire property, because for same amount of properties you have way many buyers available in the market to jump on it, and that's what driving the sentiment of paying more than what the seller is expecting. And we have seen in the month of January and February the records have been broken with regards to the highest price growth in the country. And you can see the average house price compared to MLS composite benchmark is exponentially rising from January 21 all the way up. Because of these markets are super crazy, especially Toronto, GTA, as well as Vancouver and the suburbs of Vancouver, the typical investors are looking for a positive cash flow properties elsewhere. Calgary has been one of the target market for those investors, and we have seen a lot of Toronto realtors who have been dealing with the pre-construction condos for the last few years. They are now flogging into the Calgary market to buy these pre-construction condo projects, and they are selling like hotcakes right now, because when you see a one-bedroom condo is being sold for $250,000, that's a no-brainer for them. The type of investors who are buying these condos are only looking for positive cash flow property, maybe not for the price appreciation growth as they see in Toronto and Vancouver, because Calgary market is very different. The dynamics, the population, the residents' priority in terms of living in condo is very different from Toronto and Vancouver. That's an interesting market move that we are seeing, because the capital is moving from one area to another. When you see there is a less chance of getting cash flow from properties in Vancouver and Toronto, then you're basically speculating on the price growth. Now it may or it may not happen, especially when the prices are so high. It is very risky to invest into this market, because the market is going to see a possible correction at some point, because this is completely unsustainable. So the seasoned investors are now moving into the other areas like Calgary, where they can park their money for positive cash flow generating properties. And I think nobody is surprised because of these market movements, because we have seen the currency has been devalued significantly over the last 2 years. The amount of fiscal deficit that we saw from the federal government, which is financed by Bank of Canada, and the amount of credit growth in the commercial banking segment towards these residential mortgage industry has been exponential. When we see amount of new credit being produced, and if we don't have enough economic growth happening in the industry, then ultimately what it's going to do is going to inflate the consumer goods and services, which is why we're seeing the highest inflation rate in Canada since 1991. And it's not surprising, it is not only Canada, because it's happening across the world. What we saw in the US, 7.5% inflation since last 40 years. Europe is suffering with the high inflation rate as well. Even though I don't agree with the government published figures with regards to inflation rate, because I see the actual inflation is much higher than that, perhaps in the double figures. But we have to take the lead from Stats Canada in this regard, because that's the data that everybody looks at it. From Bank of Canada perspective, if they want to hike the rates, or other financial institutes to increase the mortgage lending rate, and that's based upon the inflation rate. Now, a lot of economists are predicting that it's going to have at least 7 or 8 rate hikes in a year. But I was seeing, an article from David Rosenberg, and he's actually warning the economist that, if Bank of Canada is going to hike rates more than 3 times, they are playing with the fire, which I believe, because the market is not really healthy. The economy is not really healthy. Because if you look at that, what's happening across the globe, a lot of supply chain disruptions are caused by COVID, and now with this geopolitical conflict, because of Russia and Ukraine war, this is going to escalate further the supply chain problems, and which is going to put upward pressure on the inflation rate as well. Now, these sources of inflation is going to be short-lived. Looking at that alone, you cannot increase the interest rate, that 7 or 8 times in a year, because that will overshoot the economic contraction, and that's going to significantly impact the economic growth overall. Not just the housing. Housing will be collapsed for sure, but it is going to also impact negatively overall economic growth. So I think my conclusion is Bank of Canada is definitely going to raise the interest rate next week, perhaps 0.25 or 25 basis points, and perhaps they will do 2 or 3 hikes in a year, and then they will take a pause, because they have to carefully see how the economy is going to absorb that rate hike, right? So the market sentiment is pretty hard to judge these days because of all these different factors and cross currents. So this will be interesting to see how these rate hikes are going to hamper the overall economic growth. Not only just the housing for sure is going to react based upon the interest rate hikes, but keep in mind the fixed rate is already over 3%. Okay, it's just the variable rate that is bound with the overnight rate set up by the Bank of Canada. If we are only thinking that the market will going to react based upon the variable rate, I don't think this will have a significant impact from the housing perspective, because the fixed rate is already over 3%. So we are already getting there with regards to pre-COVID interest rate levels. If the variable rate is still around 1.5%, and if interest rate goes up, then of course the variable rate will also rally to, let's say, 1.75 or 2%. And this is where we will see, how much housing activity is going to be impacted as a result of that. I covered a lot in this video. I hope this is helpful. And if you have any question about the interest rate or monetary policy or housing market in general or in GTA, feel free to put your questions down below, put your comments down below. Let me know what you think. Ask me any question, and I will be more than happy to answer your question. And if you like this video, give me a thumbs up and hit subscribe, and I will see you in my next week video. Take care.